The broadcast is now starting. All attendees are in listen-only mode.
Good morning, Jags. This is Fahad. Today is Wednesday, August 26th. Let's get started. I was reading this news on Bloomberg this morning about this hurricane coming big time that is going to be categorized as catastrophic Category 4 hurricane, Hurricane Laura, that's gunning for Louisiana and Texas in the next couple of days. Now, there was a hurricane that already came just a day or 2 days before that, which was much smaller, and going to be looking for any kind of pickup in option activity, whether it's call or put option activity in selective stocks that tend to move tremendously around this particular news each year when hurricanes come. Naturally, we know the most obvious beneficiaries are Generac, symbol GNRC, as well as Home Depot. But they tend to bake in quite a bit of optimism related to these kind of events each year already. And this is expected to do about $30 to $35 billion in damage, $25 to $35 billion in damage, according to Enki Research Group, quoted by Bloomberg this morning. It's much smaller than Harvey, which did more than $170 billion in damage back in 2017. So it may not be any event at all. But one thing I will point out that we're not seeing any kind of pickup in the gasoline futures prices, even though a lot of the refiners, Valero, Marathon, Phillips 66, in the last couple of days, they've already announced that in the Gulf of Mexico, they have shut down their production, taking out anywhere between 20 to 40% capacity for the short term, but still that has had no impact on the gasoline prices. So maybe this is a non-event at this particular time, but if this thing gains steam and becomes a much more powerful Category 4, Category 5 hurricane over the course of today or tomorrow, then I think we're going to see some pickup in option activity in some of these selective names. And when I do, I will definitely bring that up in the chat room. So something I just want to point out because this is going to be in the news in the short term. Next thing real quick is Roku. I pointed this out multiple times, and I showed the chart on Monday and then once again on Tuesday in the chat room. And here's a chart that I showed on yesterday in the chat room, and I mentioned that this thing is sitting right at a major important trend support where it is likely to bounce off after building this small base for the last 2 weeks. Well, you're getting exactly that. The stock is closed at 147 yesterday and is popping to $152 in pre-market. That's after, if you look at today's first read, Citigroup is initiating the stock with a buy rating today, and with a $180 price target. And they basically talk about the BZNet is telling investors in a research note that disparity reflects the market view of current account economics improving, augmented by account growth. And when they apply over the next few years, the market valuation of $330 of economic value per subscriber to their account, to each account, then they believe that the reasonable price target for the stock is $180 per share. Now, keep in mind that we have talked multiple times in the past, including the chat room as well, that the growth rate that we have seen emerge from this company was above 40% year over year. Going into earnings and even post earnings, the channel checks continue to point that out. And so let's see if this thing is going to actually pop up even more, because there is this thing is going to be breaking out from the base and clearing some VOP resistance level that could easily take the stock to $160 per share. So it closed at 147, going to open around 152. It may immediately pull back right after market opens, maybe down to 150 for a touch, and then make another leg higher, and then gradually make its way to $160 per share. So keep an eye on this. I'm sure we're going to see some pickup in short-term call option activity in Roku. Last thing I want to point out is just a high-level view on restaurants group. So there is an interesting, a couple of days ago, I posted that travel leisure Travel and Leisure podcast in which I talked about that business conditions are starting to get a bit more normalized in the service sector. Well, guess what? This morning, there is this note out from Bank of America, and then combining that view with what I look at directly, the raw data that comes out from OpenTable, which is a subsidiary of Priceline, we're starting to see stronger than expected return to the dining rooms in national restaurant chains around the country. Reservations have started to pick up, and they're at the best levels, since COVID disruption. So this is just another layer to the same theme that I highlighted in the podcast about travel coming back, leisure coming back, and such and such. There are 4 states, or there are 3 states, and then the United States combined that is present in this chart: California, Florida, Texas. These are the states that naturally were the trouble spots only until a month or 2 months ago with rising COVID cases. And you can combine that with the entire country's picture, USA, and you will see that we are at the best levels over here. Looking through some of the commentary around this, what we find out is that there was a record online wait at Olive Gardens and Outback Steakhouses on last Saturday. Record online wait at Olive Gardens and Outback Steakhouses last Saturday across the country between 6:30 and 7 p.m. according to OpenTable. Both saw meaningful improvement this week, and they have much improved from 3 weeks ago. The percentage of Olive Gardens with sub 15 minute quoted dine-in waits was 64%, down from 70% last week and 80% from 3 weeks ago, suggesting improving dining demand, which is also depicted in this chart in front of you. Also, the research note points out that they have seen record online wait times at Outback over the past month and a half, which have seen similar directional trends to the Olive Garden figures. Outback wait times were 10 to 20 minutes or shorter were for 48 locations, down from 66% last week and 68% 3 weeks ago, meaning that, up until 3 weeks ago, you could easily find a spot between the prime time for dinner between 6 and 7:30, and now it seems like there is actually a wait even online to get a table. It could partly be because a lot of these restaurants have simply cut back the dining space, created more spacing between tables. As a result, the capacity is down, and while diners are starting to go back to these restaurants, which is creating a little bit of longer wait times, I think that is definitely in play. Nonetheless, this is bullish for some of these restaurants. Now, with all of this said, what I'm looking for, if there's going to be a rotation again from growth to value, the 2 dining stocks that I've seen a tremendous amount of upside call option activity in the past, particularly leap call option activity. One is Blooming Brands, symbol BLMN. For those who do not know, Blooming Brand owns the Fleming's Steakhouse, which I always thought was the most underrated one of the steakhouses in the country. But it owns that. It also owns Outback Steakhouse, so it's Blooming Brands that owns the Outback Steakhouse, Carrabba's Italian Grill, Bonefish Grill, and a bunch of other smaller names. Now, this thing has been basing, but it has been making higher highs and higher lows. And if you look at the option chain in BLMN, you will see there is over 10,000 open interest in the October 15 calls, 10,000 open interest in the January 10 calls, and the 10,000 open interest in January 15 calls. Particularly these January call options, they were accumulated right around over here in April after a major washout in the month of March. So these bulls have been quietly positioned. They've been holding those leap call options for several months now. But I think they may start to get paid if the dining business starts to come back. So keep an eye on BLMN. The next one is going to be Darden Restaurants, DRI. And Darden Restaurants is the one that owns the Olive Garden, which I just discussed, as well as Longhorn Steakhouse, Fine Dining, Capital Grill, Eddie's V Prime Seafood, Wild Fish Seafood Grill, and Yard House, Season 52, Bahama Breeze, and a whole bunch of similar kind of restaurant. Same kind of technical setup in DRI as well. And if you look at some of this leap call option activity that was accumulated in the October 85 calls, as well as out of money January 95 and 100 strike calls. Let's see if this thing can start to push up through $85 resistance. And if it does, there's major air pocket above this stock that could carry this all the way to 111. Going back to BLMN real quick, this one, if it starts to push up above 1310, you can see there's major air pocket above this stock. So you could have 10, 15, 20, 25% rally coming in this group in a very short amount of time if this group really starts to run, considering that the trends are improving. That's it from me. Jay.
Morning, Pod. So 3 items to talk about. Going back to the hurricane, right before we got on, Chronicle made the point of, the insurance companies, looking at them. I just logged into Stifel, and KBW does have a note out talking about how they expect to see some modest pressure on the P&C reinsurance companies today. Now, I haven't actually looked at the entire note. I did send it over, but they do break down pretty much all of the stocks, all of the companies, and their catastrophe exposed market share when looking at Arkansas, Louisiana, and Texas. So if we see anything there that jumps out at us, and if there's any option activity, we'll pass it along. Number 2, I plan to have a homepage article later today on a company called Federal Signal, ticker as FSS. This is a manufacturer of specialized vehicles for maintenance and infrastructure markets. They operate such vehicles like street sweepers, sewer cleaners, hydro excavators, water blasting equipment, dump bodies and trailers, as well as road marking and line removal equipment. There was a note out from KeyBank recently talking about how the company looks to be seeing an increasing adoption of hydro excavation, which is also known as safe digging. So I'm going to look into this a little bit more and provide a homepage write-up later today.
Sounds good. Another name that I've never heard of, Federal Signal. So looking forward to what you discover in this research and what you have in this article. So nice technical setup too. If this thing starts to clear 3350, could have material room to run from here. Major VOP congestion over here.
And then lastly, stock is called Chart Industries, ticker is GTLS. This is a manufacturer of equipment used in the production, storage, and end use of hydrocarbon and industrial gases. I've actually covered this name a couple times. If you go back to April earnings, the stock popped about 15%. I then did a behind the numbers write-up in the weekend research and talked about how they were seeing some tailwinds from COVID-19 as their medical oxygen specific orders were up 34%. Then fast forward to July, stock popped again, up about 17%. And once again, medical orders were up, I think, 24%, if I'm... Yeah, so I shared a screenshot from the notable callouts that I posted in one of the first reads. So the medical orders were up, but also a comment that caught my attention from the conference call was that they said we're currently working with 8 different customers under non-disclosure agreements for hydrogen applications, compared to being under 4 at the end of Q1. Now, yesterday, there was an announcement where Chart Industries said they are divesting its cryobiological products business to Cryoport, CYRX, another name that has done very well for us. They're selling that for $320 million. Company came out with revised guidance due to the transaction, and Stifel was then out talking about how let's see, they say, we feel shares are appropriately valued on the basis of the core industrial gas and LNG business, but hydrogen is a call option that could transform the value of the company. Historically, Chart generated revenue between 15 to 30 million on hydrogen. But the specialty market, which houses hydrogen and is part of the new and, in their opinion, improved corporate segmentation, is on pace to generate 132 million, roughly made up of 20 to 25% hydrogen revenue. Chart expects the specialty business to grow by 35 to 45 million in 2021, implying up to a doubling of hydrogen revenue. Management has indicated that the addressable market for hydrogen by 2023 could be as much as 600 million. So, the hydrogen market caught my attention on their last earnings call, and with this divestiture that they're doing, something to keep an eye out.
So doubling of the number of customers they were serving from Q2 to the rest of the year, that's a very, very strong positive looking commentary right there. That just tells me that the oxygen as well as the hydrogen business is just going to stay on fire for the rest of the year. That's got to keep a thick bit underneath the stock for quite some time, because I could see this thing happening potentially for a couple more quarters, the strength remaining with the company before we start to see comps get difficult for linear extrapolation starting from Q1 of next year. So interesting stuff. And stock is deservedly higher, broke out to new 52-week high, maybe one to watch, because this thing will probably continue to march in the same direction with higher highs and higher lows. Good stuff. Chronicle?
Morning. Bullish view this morning, Celanese, symbol CE. I've gotten bullish on chemicals ever since I saw how the July ISM manufacturing survey showed a sharp improvement for the chemical products industry. This industry has been seeing steady expansions in new orders and production for a couple months running now. Celanese is the leading producer of acetyl, but they're also very well diversified. And in the latest survey, there was this quote from a chemicals respondent saying that they're seeing an increase of about 35 to 40% in new orders. And the next survey coming out next week will be one to watch as well. Within this space, I like Celanese because they have a very strong moat in China and Asia, which represents just under 30% of sales, particularly in the automotive and electronic sector. We already know about China's resurgence in automobile production. Meanwhile, the most recent improvements in the latest German soft macro data have been driven by anticipated automotive export orders as well. And if we look at the first read, Germany overnight extended its furlough and subsidy program to last until the end of 2021. Their jobs program has been a strong pillar for their automotive sector, and Germany is about 34% of Celanese sales. But what I liked most was several things in their most recent earnings. Firstly, their profits from their joint ventures in China were up double digits year over year. Secondly, management said they're already seeing a stronger recovery from Europe in the auto sector. And lastly, because of low inventory levels in China, the company is directing more acetyl chain volume there. And consistent with the ISM survey, management is seeing demand recovery in the third quarter orders so far, and a solid, quote unquote, solid recovery in the automotive end market. So right now, it's a China and Germany story. The US is also a quarter of sales. So if the domestic picture improves, then that's even better for the outlook. But I think even now, the current recoveries in China and Germany should be good enough for upside.
Some really interesting quotes in this note that you have here from the management naturally speaks to quite a bit of optimism. Demand in the coming 6 months is stabilizing at a significant reduction, and clear that customers have little confidence in the forecast. Export orders to Brazil are largely canceled for the rest, but then they see this thing greatly improving. So maybe the bottom of the bar or the trough commentary is now already behind us, and any kind of commentary from here will just be a sequential improvement from the prior month. I mean, when a business is down more than 70%, what else would you expect, right? It just seems like that and then following these kind of things, maybe the consensus has taken the street estimates down also to a level where it's easily beatable. So they will have to revise those numbers higher constantly, because you get a 70% down business and then suddenly you come out with a comment that we have seen a 35% to 40% increase in the order pickup. I mean, right there is a tell that forward consensus estimates is likely to move higher, or if they don't move higher, we expect sharp beats in response to these kind of comments going forward from here. So interesting stuff. Technically, also looking at this chart, this is a bull flag, and we started to see a breakout in form in the last 2 days from this. Let's see if this thing starts to clear $105 per share, and if it does, who knows, could be on its way all the way to 121. And so nice technical view on this one as well. Abo.
Good morning, everyone. I'm looking at a company called Upland Software. UPLD is the ticker. They've already reported at the beginning of August. Their company provides cloud-based enterprise work management software applications. They're mainly sales as a service, transitioned, I think, a couple of years ago. It's not all that relevant at this time because I think they're pretty well done. So they reported earnings on the 6th, and then the day following, you can see that it spiked. That was a Friday. Then on the Tuesday or the Monday following, they announced a 3.5. Let me just get the exact figure here. They announced the secondary 3.5 million shares, which caused that subsequent big drop of the gap, which it's kind of digested at this point. Yesterday, there was a ratio bull call, bullish risk reversal ratio call spread done out in January. So the trader bought 500 January 40 calls, sold to open 1,050 calls, so 1 by 2, and then also sold to open January 20 puts. Not a huge. It says 1,000 there. That's.
Yeah, they're trying to keep the price down, or the entry as down as much as possible, and get as close to the break-even level as possible compared to where the stock is trading. They sold the January 20 puts, they bought the January 30 calls, and they sold more than they bought of the January 60 calls. So looking for a potential sharp move while keeping the cost down as much as possible. The stock lifted higher with a power candle yesterday as well. The volume has been rather pretty heavy during this basing formation. So, from a technical standpoint, this is a very easy entry in, because one could simply put a hard stop at $32 per share with the stock at 36 right now. Look for continued recovery. MACD and RSI bull crosses are also in front of us.
Yeah, and Needham had a bullish note out shortly after the earnings, where they raised their price target to $53, up from $40. Cited their organic growth, which was 6% in first quarter and then 8% in second quarter, which was above the company's 3 to 7% range. And their product suite demand was had accelerated. It was noted, and the analysts kept it as their top pick for the year. Total revenues were up 35%, or 34.5%. There's a lot of positives in this one. I think kind of plays out a little slower than the others. I don't know. I think the secondary had a little bit of a dampening effect on the shares, but I like this name, and we haven't talked about this one all too often, maybe a couple of times over the years.
It's not expensive either, which has been my number one concern in the software space. Trades at 4 times sales compared to froth that we see out there. And for something that is trading at only 4 times sales, that grew revenue by 37% year over year, right, for the 6 months ending June 30th. And from Q1 to Q2, the growth rate actually accelerated. So for something growing at that rate and trading at 4 times sales, yeah, it becomes pretty attractive, especially if there is reason to believe that growth rate will continue for several more quarters to come. Interesting one. And I really like the technical setup because it's an easy one to enter with a hard stop, tight hard stop at 32. So that provides some cushion from the entry standpoint for a potential recovery all the way to new 52-week high.
And it's also one of the few companies. Sorry, I was just going to mention that it's one of the few companies that did provide forward guidance, and for fiscal year 2020, they raised their range from 257 to 269 million previously to 273 to 281. So it went up by 20-ish million on either side, 19, 20 million. Oh my!
Yeah. So on a forward-looking basis, this is at 3.5 times sales, growing 37% year over year. Right? I mean, it seems awfully cheap. Maybe just a forgotten name. Maybe just a name that's been overlooked by the community and the investors so far. I'm going to add this to my watch list. I'm going to watch it from here, see how it trades, and maybe we'll have a trade idea on this one. All right, great stuff, guys. Thank you very much. See you in the chat room shortly.